Well, last week, the House passed a massive $1.7 trillion government spending bill in order to avoid a government shutdown, and it did include in it the retirement savings provisions known as the Secure Act 2.0. Financial advisor Gregory Ricks is here to break it all down for us. So yes, first of all, thanks for being with us.
Oh, good morning, Leslie.
Good morning. What is the Secure Act 2.0? I dove into this, and it's a lot.
The Secure Act was passed in 2019, and this builds upon it actually in a pretty big way. There's a lot of changes coming to it.
Okay.
And I'd say most of it's good.
Okay, so yes, these changes are intended to expand access to retirement savings and help workers kind of maximize their retirement accounts. And how? Give us some of the ways that they're helping people do that.
Well, one of the complaints we always get is people are saying, I don't want to take RMDs, required minimum distributions. Well, this pushes it back in 2023 to start at age 73.
Okay.
And by 2030, it pushes it back to age 75. So that helps some of the people that would like to keep working and deferring. Expanded catch-up contributions are the next important thing. You know, most people over age 50 have catch-up contributions. At age 62 to 64, that's expanded higher. It gives them an opportunity to put an additional $10,000 away each year for that. And another one of the biggest impacts I shared with you is this opens up to more people. So it allows automatic 401k enrollments for most firms. So they're signing up for it. Now,
yeah, because there's a lot of companies that don't have 401ks. Starting in 2024, that's going to be mandatory, or more people?
Well, I'd say almost mandatory, but firms are going to enroll people automatically. Now, employees can opt out or reduce the amount of their contributions in that way. And another important point is part-time people that have 500 hours 2 years in a row can join the 401ks.
This is huge, because a lot of people, I mean, maybe taking care of kids, they can only do part-time and they need some retirement help as well. What about student loan matches? This was something that I hadn't seen before.
That was the next thing I was going to bring up. So it gives incentives for paying off their college loans, and employers can match it. An example would be if you made $200 payment towards your student loan, your employer will add $200 to your retirement plan.
I mean, that could be a game changer for people paying off student loans.
Once again, more incentives to save and put money away. It's really important.
And then what about savers credit improvements? What does that entail?
There's two parts to that, but it allows more incentives for people, make it easier, more beneficial for low-income earners to save as well. There's also going to be an emergency savings element to that also, and it allows for people prior to age 59 and a half needing to access money for emergencies, the 10% early withdrawal penalty can be waived. In a lot of cases, it's very expanded in that area.
And that's huge, especially during COVID, the pandemic, and people who own businesses. A lot of people had really had to dip into their savings. So being able to withdraw, is that just like a one-time thing? How does that work?
Well, there is a one-time thing where a $50,000 can be shifted, but that's a whole nother segment we need to talk about.
No, right, we need another segment.
But it's not a one-time thing. The $1,000 could be yearly as well, and the emergency savings element that can be added to your company plan is something that can be used ongoing as well. So it creates so many options for people. I'd say Secure Act 2.0 is going to be pretty awesome for most people.
All right, good to know. Thank you so very much for your time. Let's get over to Peyton.